All right, well, let me do the honors of kicking us off. We have a great event tonight. So thank you everyone for coming. My name is Tracy Clark and I'm head of marketing at Parsec Financial, the sponsor of the event tonight with UNCA. Thank you so much for joining us, albeit virtually. Parsec was founded 41 years ago by my father, Bart Boyer. Back then, as it is today, it is so much easier to look back with certainty versus looking ahead to uncertainty. As our beloved Dr. Smith commented, when Bart Boyer founded Parsec on March 28, 1980, he was flying in the face of the most awful economic headwind of the entire post-World War II period. The US and many other advanced economies had been experiencing stagflation throughout the 1970 to 1979 period. That was a period of slow economic growth with high inflation and high unemployment rates. Or, as my father more bluntly put it, the timing couldn't have been worse with the 1980 to 1982 double recession, 17% home mortgage interest rate, a few good years, and then sadly the 1987 stock market collapse. And I'll also add in that in 1987, my parents had 4 children ranging from 2 to 7. I was the youngest twin and no family nearby to help. So what uncertain times. But thankfully, as we all know now, my father was a fearless and tireless entrepreneur and focused on the present and what he believed in that moment and what he still believes today, in that people deserve financial security and he could help them achieve it by acting as their fiduciary to provide transparent and trusted guidance. Now we are in another period of great uncertainty. Last April, Dr. Smith wrote an article for Parsec titled, "Will the coronavirus spark a recession, a depression, or what?" I had asked him to write it for Parsec clients to provide insight into what was happening around us. In his article, he wrote, "Unfortunately, no one can possibly know the true outcomes, so all the numbers you hear and see are mostly speculation, usually based on some educated assumptions, but speculation nonetheless." It feels eerie rereading his article today. The Department of Labor had just released its latest report that 6,648,000 people, seasonally adjusted, had filed new unemployment claims, and the CARES Act had just been announced. Dr. Smith went on to say, the really big unknown is, of course, how long the severe policy of imposed limits on economic activity will last. That is a function of how well we manage to hold down the number of cases of COVID-19 in the US. No one knows the answers to these 2 questions. How right he was that none of us could have known what the last year would have in store. I send my condolences to anyone who has lost a loved one from this pandemic. I believe that unfortunately we have all been negatively impacted by COVID and it will take time to heal. However, I encourage you all to take the mindset of my father 41 years ago to focus on the present and try to make a difference in the lives of others. Everyone at Parsec was sad to hear about the passing of Joe Sulock, and we are sorry to hear that Dr. Smith can't present today, but he is definitely here in spirit and looks forward to rejoining in the years ahead. So even though the future is uncertain, we can make certain that we optimize the present by celebrating life, love, health, family, and happiness. Thank you for being here again today. Appreciate it.
Let me add my greetings. My name is Robert Tatum. I am the Cary Caperton Owen Professor of Economics here at UNC Asheville. Let me add my warm welcome to Tracy and Parsecs. Welcome to UNC Asheville students, faculty, staff, alumni, our Parsec friends, the greater Asheville community to this, the 36th annual Joseph M. Sulock Memorial Economics Crystal Ball Seminar. Let me also say how grateful we are for the generous and unwavering support Parsec has provided since at least 2008. We could not have done this without them. As some of you might remember from the 1980s and 90s, there was this television sitcom called The Golden Girls. It started around the same time as this Crystal Ball series did, and here we are still, Emmy-worthy perhaps. Anyway, one of the main characters, Sophia, had this penchant for telling stories that begin with the words, "Picture it, Sicily, 1945. Let us for a moment picture it, UNC Asheville, Lipinski Hall, April 2019. Many of you don't have to imagine it though. You and I were among the 400 or so unmasked folks at the last Crystal Ball event. You were welcomed by bright and friendly economics students. You had hors d'oeuvres and wine, and then you settled in to hear Joe Sulock's wonderfully funny and polished introduction. Then you heard David Berson and Jim Smith's amazing economic insights and forecasts, as well as their witty banter. Wow, hasn't the world changed a lot since then? Now David and Jim have been wonderful with their economic forecast at these crystal ball events for all these many years. But I don't think they could have even fully predicted what we have seen in the last 2 years. Although we have much reason for hope, we have lost a lot in this year due to the pandemic, just like Tracy was just talking about. And also, as she mentioned, in July, we lost the creator and organizer of this event for 35 years, Dr. Joe Sulock. Let me talk a little bit about Joe, and particularly since this event was appropriately renamed in his memory. He was the most student-centered professor I've ever met, whether in his econometrics course, his sports and economics class, his public finance class, or in the voluntary income tax assistance course he taught even in retirement. He had an open door policy where students and colleagues alike sought his sage advice. Much of his efforts were uncompensated with no direct reward to himself, whether it was advising the student-led economics club, organizing the International Student Forum, assisting Big Brothers, Big Sisters, or putting together this event series. He worked diligently for the benefit of the students, the university, and the community. Of the countless efforts Dr. Sulock made in support of his students and the Asheville community, I don't know which one he would want to be remembered for as part of his legacy. I do, however, know the untold times, and I mean untold times, he came by my office or met with me for lunch to make sure that I would keep the department scholarship and awards program going strong. I mention this here because his legacy of raising funds for the department scholarships dovetails with his legacy for this event. Over the years, David Berson and Jim Smith have been generous in donating their crystal ball speaker fees and more to a scholarship fund for UNC Asheville economics majors. Others of you have joined them. This fall, that fund has been renamed in Joe's memory, and grateful alumni and friends added to that fund to support the UNC Asheville economics students for generations to come. If you would like to honor Joe's memory and build on his legacy too, there's room for you. Reach out. I promise it will make a difference in our students' lives. I see it every day. Now, with the loss of Joe and with the pandemic, this year's event certainly looks different. One of the staples of the events, one of the great characters and experts of this event, Dr. Jim Smith, won't be on stage tonight. But Jim was so supportive of continuing this event. However, he faced some unforeseen circumstances that kept him from presenting here tonight. But he looks forward to being back with us next year, though. And if you still want to get a word from Jim, as I do, he was actually just cited in not just one, but 2 articles in the Wall Street Journal on April the 11th. So the task of carrying the show tonight then rests with the uber capable Dr. David Berson. Dr. Berson is a senior vice president and chief economist for Nationwide Insurance. His numerous previous professional positions include vice president and chief economist at Fannie Mae, president and fellow of the National Association of Business Economists, and a senior management position with Wharton Econometrics Forecasting. About David and Jim, Joe would always say to me that they are top-notch business economists, experts who can pour through the data to give us an excellent sense of where the economy is headed. True golden guys, if you will. Even as an economist myself, I will be sitting on the edge of my seat to hear what David has to say about where the economy is headed in the wake of the pandemic and the unprecedented monetary and fiscal stimulus we have had. After David presents, he will answer some questions from the audience. You may submit questions at any time through the Zoom's Q&A function. You'll see that button down there. So use the Q&A function to ask questions. For any technical questions, though, instead use the chat function. So David, help me picture it. UNC Asheville, Lipinski Hall, April 2022. As we hopefully come back together in person next year, what will the economy look like then? Welcome back, Dr. Berson.
Rob, thank you very much. It is so nice to be here with all of you, even if it's only virtual. Let me start out by thanking Tracy. Bart and Parsec have been such great friends to the Crystal Ball for many, many years. We would not have had the Crystal Ball were it not for Parsec and Bart's support. Second, I have it on pretty good authority that Dr. Smith is viewing this tonight. So he's out there. We may even get a question from him. We'll see. I hope it's one I can answer if he does ask. Third, before I answer your question, Rob, Joe Sulock. Joe was a very, very good friend, obviously a great economist. And the answer, of course, to the question of with sports economics, won't this public stadium actually make money for the city? The answer is always no. They never do. And that would be Joe's answer. They never do. And it's, of course, the right answer. Joe was a great golfer. We would always play golf when I was there. But Joe's great sports love, and mine, baseball. We were both coaches for our kids' teams, and we loved that. And we would talk baseball for hours when I was in Asheville with him. So I will miss Joe, as I know we all will, a great deal. So I'm going to put some slides up. Let's see if I can actually do this. There's a share screen button, and there it is. And there's the deck. And hopefully you can see this. And we will go to slideshow. Hello. And we'll go from the beginning. Here we go. All right. I think we've got it. So the quick answer to your question, Rob, is that a year from now, the economy will be not only above, and we'll see this in a minute on a chart, not only at a level beyond where we were when the COVID recession hit at the beginning of last year, but if the recession had never occurred, if we'd not had the coronavirus, where would the economy have gone? A year from now, we may well be at a point even higher than that. So that's doing pretty well. So because Jim and I aren't on stage talking, tonight you get to see all my pretty pictures. And occasionally I would do charts in Lipinski Hall, sometimes not, but tonight you get the charts. So this is quarterly real GDP. And you can see that big drop. For us, it was in the second quarter of last year. First quarter, there was a pretty big drop. I could go back farther, and we'd see that the drop in the second quarter of last year was the biggest one-quarter drop in economic activity in the history of the United States. We'd never seen a quarter worse than that. Were we headed for a depression? We were in a depression. We're short, but we were in a depression. But then look at the big jump in the third quarter. The biggest one-quarter rise in real GDP in US history. The actual quarterly growth rate was bigger than the drop, but because of the magic of compounding, when you have a big drop from a larger number, as we did in the second quarter, you don't quite make it up. And then in the fourth quarter, we'd still pretty good growth. And we're about to get the first quarter number, and when we get that, it's still going to be pretty good growth. But we ain't seen nothing yet. Wait till you see what happens for the rest of the year. Here's our forecast, the light blue bars on the side and the history on the left. So you can see from 16 to 19, we had decent growth. If you look at real GDP growth from the end of World War II to the end of 2019, the economy averaged growth of a little over 3% a year. If you looked at growth from the end of the Great Recession, 2009 to 2019, it averaged a little over 2%. And that's about the average that we saw for those 4 years. Then we had the minus 3.5%. Huge drop, bigger than any annual drop since we were coming out of World War II. And the economy was shifting from a full war footing to peacetime. A huge drop. Worse than that 79 period, worse than 80, 81, 82. Just terrible. Why? Well, the coronavirus and the government's response. We now know what happens when the government shuts things down. Now, fortunately, we didn't see everything shut down, and nor was everything shut down for very long. Otherwise, we would have seen a much worse downturn. And what was a really bad recession, indeed would have been a depression, but for governments allowing some at least limited reopening of the economy, starting in about June of last year, a little bit in May of last year, and running through year end, as well as unprecedentedly expansionary fiscal and monetary policy. We'll look at that too. Now that's carrying over to this year. Plus, we have more expansionary fiscal policy. Plus, some people are calling it QE forever, the most expansionary monetary policy on record. That's going to give us growth this year. Well, our forecast at the beginning of this month was 6.1%. We have new data since then. Today we got retail sales for March, for example, and they were blowout numbers. Retail sales for the month were up almost by 10%. Now, part of that was because last month we had terrible weather, particularly in the south central part of the US. Remember Texas and all those homes that were frozen. Believe me, for an insurance company, we know about those homes that were frozen. So we had a rebound in that. But we're going to have growth this year over 6%, maybe over 7%. It's going to be the fastest growth in the economy since 1984. And you know what? If we get growth even a little faster than that, say 7.5%, 8%, and we could get there. It would be the fastest pace of growth for the economy since 1951. That's even older than I am, and I'm getting pretty old. Then we'll get spillover effects to next year, over 4% growth, and then the economy starts to moderate again. We're not going to get the expansionary fiscal policy year after year. The economy will already have been fully reopened by then. By July, the US economy is going to be awash in vaccines. The J&J vaccine will come back, hopefully another week. But between Moderna and Pfizer, we will have plenty of vaccines. And by July, if you want to get vaccinated, you probably won't have to search. I had to search very hard. Probably many of you did too. By July, go to the CVS or the Walgreens or the local grocery store. You probably, without an appointment, just be able to get a COVID-19 vaccine. So hopefully at that point, between people who are vaccinated and people who got COVID and recovered, and that's most people who got COVID recovered, we will be at around 75 to 80% of the population. By almost any measure, that's herd immunity. Now, that doesn't mean the other 20% can't get coronavirus. Some of them will. In fact, the pickup we're seeing now are in parts of Michigan, Minnesota, a few other states where vaccination rates tend to be relatively low. But by July, vaccination rates will be much higher. We will see, as a result of that, the number of people with COVID-19 going way down, and we'll see governments increasingly opening their economies. But by 2023, at least by the end, fiscal policy will be much less expansionary. Monetary policy will start to not be as expansionary as well. So it's still growth that's faster than much of what we saw before COVID, but slowing. Here's a chart that shows the level of GDP, and that's the blue line. You can see at the end of 2019, all of a sudden, it deviates from that upward trend, which are the dashed tan line, which is where the economy would have gone if we hadn't had COVID. Assuming that we would have continued to have trend growth, and that's probably a reasonably good assumption. But look how the blue line went down. That's a huge drop in the level of economic activity. But we have a big rebound. Clearly a V-shaped recovery. It sure looks like a V to me. Well, the dashed blue lines are our forecast of where the level of GDP will go. That little dotted horizontal line was the peak level of GDP, where we were in the fourth quarter of 2019. Well, we're going to get there perhaps by the end of the second quarter, maybe the end of the third, but I think by the end of the second quarter, we will have gotten to and probably past the previous peak in GDP. But again, as I mentioned earlier, where would we have been if we hadn't had COVID? It's the dashed tan line. And we get to that point at some point next year, probably the middle of next year. the level of GDP will be above where it would have been if we hadn't had COVID at all. As you go farther out, the level of GDP will continue to go up, but the pace won't be any faster than it would have been. So the difference between the level of GDP that we're forecasting and the level of GDP, if we just seen trend growth, will stabilize. And so there'll be parallel lines at that point. GDP is not the only way to look at the economy. We also look at the unemployment rate. And here we have it in two different forms. The blue line here is the U3 unemployment rate, what we normally look at when we look at unemployment. Now, to be unemployed, you have to be in the labor force. You not only have to be in the labor force, you have to be looking for a job. Well, to be in the labor force is very easy. You either have a job or you're looking for one. So that's the most common way to look at the unemployment rate. And unemployment went up to about 14% in the spring of last year. It's been coming down since then. It's about 6% right now. But that understates unemployment in several ways. Let's look at first the tan line. That's the U6 unemployment rate. There is a U1 through a U6. The U3 is the most common measure. The U6 says, all right, what happens if you're employed, but you're only employed part-time and you would have preferred full-time employment, but you can't find it? Well, those people are included in the U6. So they're working, but they're not fully employed. But in addition to that, there are people who answer the survey from the Bureau of Labor Statistics and say, I'm not actually looking right now, which means they're disqualified. They're not in the labor force. So they're not counted as unemployed with that blue line, the U3 unemployment rate. But they tell them, if I thought I could get a job, I'd come back in. Put that in along with the people working part-time, but wanting to work full-time, get the tan line. Unemployment went up to almost 24%. That is the depression level by any measure. Now, even the blue and the tan line still understate unemployment. The BLS has told us that there are people who aren't working, who are at home. Well, we're all at home, even if we're working, but weren't working. But their company said, well, we're going to call you back as soon as we can. And they told the survey folks at BLS, well, that means I'm not unemployed. I'm employed. They're going to bring me back. And the BLS miscategorized those responses. And they said, those people are working. Well, they should not have been counted as employed. They should have been counted as unemployed, which would have raised those unemployment rates still more, almost by a percentage point. Actually, by more than that at the peak. Now it's less than a percentage point. So the unemployment rate by the U3, if you account for that, is in the upper 6% range, not 6. But we would have had unemployment, if you counted that correctly, using the U6 at over 25%. Now that was only a few months after the unemployment rate in February of 2019 fell to a 50-year low of 3.5%. Incredibly quick jump in unemployment. Well, the government said, because we don't know if COVID is in fact a Stephen King type plague. For those of you who have read The Stand, was it The Stand? Well, thankfully it was not. Hard to know at the time whether it was or not. Was 99.9% of the population going to die? Very unlikely. And in fact, a very small percentage did, thankfully. But we didn't know at the beginning. And so businesses were told, if you have in-person activity, you must shut down. And businesses shut down right away. People were unemployed right away. So the recovery has taken a little more time, but we can say this. It was the fastest recession we have ever seen. It was the fastest recovery we've ever seen. And the recovery will go for one more quarter. And then the recovery is going to end. Because at that point, it will go from recovery to expansion. Here's our forecast for unemployment again, the dark blue lines, history, 3.7 for the whole year in 2019. At the beginning of 2020, we were at 3.5, and then for the whole year, 8.1. For this year, we think the year will average 5.2. We're at 6% today. This is the U3 rate. We think that by the fourth quarter, the unemployment rate will be under 5%. Next year for the year as a whole, 4%. That means toward the end of the year, we'll be under 4%. We'll be back close to where we were in terms of the unemployment rate, close to where we were just before the COVID recession hit. So again, a really nasty but short recession and a really strong and fast recovery. One of the things that is on people's mind now is inflation. It's certainly on the mind of our board. I just gave a presentation to our board a couple of weeks ago on the inflation outlook. And you can see that from about 2017 through just before the COVID recession hit, inflation, this is the CPI, averaged on a 12-month basis around 2%, maybe just a tad over 2%. But look how it collapsed in the first half of 2020. There were many months in which inflation was negative. The CPI went down. But then we had the recovery. So recessions tend to be deflationary events, and that clearly was deflationary here. But inflation's come back up. It's almost back to where it was, at least for some of 2019. It's certainly not back up to 2%. But over the next several months, we're going to see the CPI on a 12-month basis going up still more. Don't be surprised if for a month or two, we don't see a 3 for the first digit. Does that mean inflation is getting out of control? I don't think so. Let me tell you why. So part of the reason why we're going to see this bump up in inflation is because of what economists call the base effects. So last year, in the first half of the year, into the middle of the year, we saw inflation go negative. So even if the monthly gain in the CPI was pretty modest, 1/10, that's nothing. 2/10, not much. We would see, because the comparison with last year, with inflation, with the CPI going down, would boost inflation on a 12-month basis. But that's not going to persist because inflation went up again in the second half of last year. So once we get to the second half of this year, that base effect will start to go away. There are a couple of reasons. Another big reason why inflation is going up is energy prices. Oil prices have gone up. Last year, oil prices plummeted, and it meant that a lot of domestic production, all those fracking fields, couldn't produce and make a profit, so they shut down. Well, OPEC has been remarkably successful in holding production down. We'll see how long that lasts. But more importantly, with the price of a barrel of oil in the US now back above $60 a barrel, oil production in the US is coming roaring back. So the boost to inflation that we have gotten from higher oil prices is about to end. Oil production in the US is going to come back. As a result, worldwide oil production is going to come back significantly. The third thing, and this is again COVID-19 recession related, was supply chain disruptions. Lots of things didn't get made. Lots of things didn't get produced because assembly lines were shut down. Production facilities were shut down. We know that, for example, lumber prices have gone to all-time highs. How did that happen? The tree farmers are producing bumper crops. What happened was the mills, a lot of people were sent home. We didn't know if the person next to you was going to give you COVID. If they had COVID, we didn't know if they had COVID. So the mills couldn't produce. They're just getting back to production now. So these supply chain disruptions, that's just one example, have pushed prices up. But those supply chain disruptions are going to end. Different times for different industries, but the impact on inflation won't persist. So this bump up in inflation is going to be real, and it's going to be big Again, we may see inflation over 3% for a few months in the next few months, but that's probably not going to persist. This is certainly what the Fed hopes, and it's what Jay Powell, the chairman of the Federal Reserve Board, has been saying. I think he's probably right here. There is a risk, of course, and the risk is that higher inflation, if it gets built into expectations, can be a self-fulfilling prophecy. People look at the money growth numbers, and we've never seen money growth as rapid as it is now. And for many economists, they would say that has to lead to higher inflation. It's what Milton Friedman taught us. Indeed, if you look at the data from way back through the present, there's a pretty high correlation between fast money growth and a pickup in inflation. Again, money growth now is the fastest we've ever seen. But if you look at that relationship over just the last 40 years, there is no relationship. Whether money growth picks up or slows, the resulting lagged inflation is completely uncorrelated with it. Will it remain uncorrelated? We'll have to see, but it is a risk. Other thing to look at, the economy relative to its full potential. The CBO, Congressional Budget Office, has a measure of potential output in the economy, what the level of GDP would be at full employment. And sometimes we go beyond that. And yet, if you look at a long, long history, when the economy goes beyond that, we tend to see inflation move up. We're certainly going to move above that, given the charts I showed you earlier. But over the last 40 years, that hasn't mattered either. So whether it's monetary policy with money growth that's just very hot, or fiscal policy helping to push the economy beyond its full employment limits, for the last 40 years, that's had no impact at all on inflation. Hopefully, that will remain the case. So while that is our forecast, and it's certainly what the Fed is forecasting, there is a risk that inflation could move up. Now, are we looking at inflation in double digits? No. But could inflation move up to 3%, 4%? There is a risk. It's not our baseline forecast, but there's a risk. So here's our forecast for inflation. 2.8% for this year is much faster than anything we've seen for many years. The economy is growing faster than we've seen in many years, plus all these other factors I talked about. So this 2.8%, nearly 3% inflation for this year, we don't think will persist. But note that going forward, we still think inflation will be somewhat higher than what we've seen in recent years, somewhere between 2 and 2.5%. That is higher inflation. It is far from runaway inflation, not even a level of inflation that the Fed will get terribly concerned about. Now, here's our forecast for inflation at the top, compared with many other forecasts. And you can see, look at the blue chip consensus. The blue chip gets 50 or 60 forecasters and asks their forecasts. So if you look at the consensus from economists, we're very pessimistic with inflation, with our forecasts there. And there are, of course, some that are higher than us, but many that are lower than us. Now, we can look at what financial markets think will happen to inflation. These two lines show the financial market projections for where inflation will be based on the 10-year Treasury note yield and the Treasury inflation protected security for the same 10 years. The tan line looks at the spot inflation rate out 5 years. You can see, and the 2% is the horizontal line there, that for the past year, it's been well below 2%, and obviously it fell almost to zero at the worst part of the COVID-19 downturn. But it's come back up, and now it's up to 2.5%. So financial markets are looking for inflation on average, this is the CPI, to be around 2.5%. The blue line looks at not the inflation rate in 10 years, but the inflation rate the market expects on average between year 5 and year 10. And right now that's at about 2.1%. It's a little over 2%. I think somewhere between those two is probably about right for the next 5 years. So I think financial markets have it exactly right, that inflation is going to be higher than it has been in recent years, but beyond the bump this year, not much higher. Let's look at autos, some of the things that Nationwide looks at. We have a lot of autos that we insure. Big drop during the COVID recession. That was amazing. But look how quickly it came back. People actually had a fair amount of money because of all the government programs. Income didn't really go down. A lot of people lost their jobs, didn't lose income. Some did, but many did not. So if you look at aggregate income in the economy, it went up. Not only that, most people were working. They didn't lose their jobs. And those people who were working, many of them were working from home. That will be more important when you look at housing. But, if you were working at work, you didn't want to take public transportation, you bought a car. Or, as we'll look again with housing in a minute, many people who lived in cities were told, well, you don't have to live near where you work. You can live wherever you want because we don't want you in the office. You can do your job fine from anywhere. So they moved to the suburbs, but they might not have had a car. They had to buy a car. They still had to go somewhere. So light vehicle sales went up a lot. And there's a sawtooth pattern since then. That the most recent down in the sawtooth pattern was February, that terrible weather month. And then we had the recovery from that, where we had light vehicle sales at almost an 18 million unit annualized pace. Huge. So we're looking for light vehicle sales to be almost 17 million this year. That's a big pickup from last year's drop. And at the bottom last year, let me go back a slide. We were down to about 8.5 million units at an annualized pace. Yet we finished the year at 14.5 million, and we're looking for mid-16s this year and in the years to come. Really inexpensive to borrow to buy a car these days. How about housing? Here's total home sales. You can again see in the first half of last year that home sales collapsed. People weren't buying homes. But unlike autos, so let's go back to autos. Autos went back and they recovered, but they didn't really go back above where they were before the COVID recession hit. But look at housing. It went way above the pace of sales before COVID. What happened? Well, one, mortgage rates went down. Not only did they go down, mortgage rates went down to the lowest level in the history of mortgage rates. They were never lower than they were in the second half of last year. If you're ever going to refinance your loan or get a mortgage to buy a house, that was the time. But unless you were unemployed, and yes, many people were unemployed, but most people were not, the job market was really good. Economists talked about what was called a K-shaped recovery. So think about the down part of the K, that looks like that big drop in home sales. But then with the K, you've got this up part and then a down part. The down part were those who lost their jobs. The up part were those who continued to be employed, and that's most people. They did really well. They took advantage of those record low mortgage rates and bought houses. And then, of course, if you were working in town, working in New York or LA or San Francisco, DC, and you were told, well, you can work wherever you want. Maybe you worked for Amazon. You didn't have to work there anymore. You could work anywhere in the country. So you went somewhere where you could actually afford to buy a house, but then you needed a car, and then you needed a house. So home sales went way up. And in fact, home sales would have been significantly higher than this, except we didn't have enough homes to sell. Home builders built as many as they could, but the bulk of homes that are sold in any one year are existing sales. And the number of existing homes for sale just plummeted over this period. Why? Well, I don't want to put my house on the market. Person comes in to look at it might have COVID. I might die. So today, the number of homes for sale, we've got data back to the early 80s, at least single family homes, has never been lower. We have the strong demand and much less supply. So home sales would have been even stronger. That big drop there, a lot of that was February weather as well. We'll see a pickup again in the coming months. So if we look at home sales, they actually went up in 2020. Home sales don't usually go up in recessions. They did last year. For again, the worst downturn that we've ever seen in one quarter. Home sales went up last year. We expect them to be higher this year. These are very strong housing numbers by any measure. How about house prices? Well, what determines price of anything? Basically supply and demand. Well, I've already given away the game. Supply was very weak. Demand was very strong. Home prices last year went up at almost a 10.5% pace. I mean, that's like housing boom pace. Ooh, housing boom. Are we going to get a housing bust? Remember, back then I worked at Fannie Mae, so I know a lot about that. No, it's very unlikely. What happened during the housing boom and bust was not a supply and demand imbalance because home builders were building huge amounts of homes. What happened then was mortgage products that were completely unsuitable for people being given to everybody. Today, it's pretty hard to get a mortgage. So anybody getting a mortgage today can actually afford it and really afford it. It's supply and demand. So we expect home prices this year to grow at a 7.5% rate. That's still really rapid. You know about rapid house price growth in Asheville. Growth in Asheville is very rapid. And it's only weaker this year, if you can call 7.5% growth weak, because we expect as COVID-19 dissipates, as we think it will over the second half of the year, it's already doing that, but further over the second half of the year, more people will be willing to put their homes on the market. So we'll see an increase in the supply of homes, and that will moderate the price gains somewhat. You'll see more of that in 22 and 23. Still decent home price gains. But if we don't see people putting their homes on the market, if the number of existing homes for sale remains de minimis, then the home price numbers I have here, our forecast, will be not only too low, but way too low. Let's look at policy now. The Fed conducts monetary policy primarily through the federal funds rate. And you can see that the Fed had been raising the federal funds rate for a number of years till it got to about 2.5%, 2.25% in 2019. And then the economy started slowing a little bit and inflation hadn't really picked up very much. The Fed thought, well, let's just make sure that we're not going to have a recession. So they lowered the federal funds rate. They eased monetary policy. Well, they didn't forecast COVID-19 any better than anybody else. Nobody did. Look at the drop in the federal funds rate. It's basically a vertical line. Think about, and let's compare this with the Great Recession. So the Great Recession began in December of 2007. The Fed started easing monetary policy a little bit in the spring of 2008, but they didn't really bring rates down until the fall of 2008, almost a year before the Great Recession began. It took a long time, but the Fed finally brought interest rates down to zero at the short end and started doing other things, quantitative easing. But it took almost a year for the Fed to go all in. You know how long it took them to go all in this time? A week. A week. Not almost a year, a week, to bring the federal funds rate down to zero. And then to start buying treasuries and AAA rated mortgage-backed securities to help bring longer term rates down. So the Fed reacted far faster than it ever has before, unprecedentedly quickly. And not only that, the amount of monetary easing that we've seen between the federal funds rate being brought to zero and the Fed buying securities is also unprecedented. So what's going to happen to interest rates? Well, by the end of last year, the federal funds rate was 0. It's going to be 0 at the end of this year. Probably going to be 0 at the end of next year. If you listen to Jay Powell, it may well be 0 by the end of 2023. We think by sometime in the second half of 2023, the economy will have recovered enough, inflation will be high enough that the Fed will, in baby steps, start to take some of the liquidity out of the economy. Now, they'll do it in terms of starting to taper their quantitative easing before then, probably sometime in 2022. But the federal funds rate probably won't start going up till sometime in the second half of 23. That suggests that short-term interest rates are going to remain really, really low for a really long period of time. About long-term rates. Here's the 10-year Treasury note yield. And you can see the bad old days. 1980, Parsec gets founded. That was, so 1981 was when I got my, when I finished my PhD at Michigan 82, but I went to California to be a college professor. Our mortgage was 17%. Ouch. Yeah, very high. But look how, since about 1981, interest rates have been coming irregularly down. And in August of last year, the 10-year Treasury note yield fell to about 0.5 percentage point. That, as it says right there on the chart, a record low. The 10-year's never been lower than that. Is that the lowest it'll ever be? I don't know. That trend looks pretty solidly down to me. Maybe it'll go lower in the next recession. But it's probably the low for this point. And right now, the 10-year Treasury note is about 1.55, 1.6%. Down a little bit. It was up to 1.8, but it's decidedly above where it was at the beginning of August. Well, why? The Fed hasn't started raising short-term rates. It hasn't even started tapering quantitative easing. Here's where several things come into play. One, we're not in recession anymore. We're seeing really strong growth. Record strong growth. Again, the strongest growth this year since 1984, maybe since 1951. We shouldn't see interest rates, even if the Fed is keeping short rates at 0. We shouldn't see market-determined interest rates. The Fed doesn't control the 10-year Treasury note. It influences it, doesn't control it. We should see longer-term interest rates higher with a growth pace like that. Inflation is not near 0. It's going to be, at least for a few months, over 3%, but basically between 2.5% and 3% for this year. Long-term interest rates should be higher. And indeed, they will go higher. How much higher? And note that mortgage rates and other long-term borrowing rates get priced off of this. So at the end of last year, the 10-year Treasury note yield was 0.93%. And again, it went down. It was lower than that in August. So it went up between then and the end of last year. At the end of this year, we think it'll be 1.75%. So that's about 20 basis points, almost 1/4 percentage point higher than it is now. That's not much of a move. And then moving up gradually in coming years as the economy continues to grow. Now, if we're right and that inflation pop is just temporary, that's why we get only modest gains in the 10-year Treasury note. If inflation comes up faster than we expect, then we'll see long-term rates move up more quickly than this. Again, our forecast is the rise in inflation is temporary, so long-term rates will go up only modestly. Now I'm going to stop my talking here. This is, of course, I always show you when I do my charts, the disclosure. Our lawyers make us say this. And what it basically says is, every forecast is wrong, including this one. Hopefully it's only wrong by a little bit, but it might not be. So I'm going to stop sharing my screen now. There we go. Now you can see me. Now, hopefully there are a bunch of questions. What did you really want to talk about?
Yeah, we have 7 so far. But first, before we start getting to some of the questions, let me say thank you. And I'm going to go ahead and clap. You can't hear other people clap, but they are there thinking about you, probably standing to their feet because one of the things, we have economics called the dismal science, but oftentimes these things are actually more comforting, that things are maybe not as bad as we think they are or will be. But let me go to some of the questions. I'm going to try to read them verbatim, and there's going to be a little bit of overlap, but and they've been coming in since from the beginning. And so the first one is, drawing on your Fannie Mae experience, do you have any policy or insight into the local Western North Carolina housing market that can help alleviate the pressures we're feeling right now?
Well, unless you're going to put fences up, the only thing you can do is build more housing. Now, that's not quite true. Asheville suffers from the same problem the rest of the country does. People who own homes there aren't putting them on the market. So Asheville's inventory of homes for sale is extraordinarily low. That will abate as the virus starts to diminish or diminishes further in the second half of this year. More people put their homes in the market. But Asheville, because it is a nice destination for people to live, always sees excess demand. You can't build enough homes in Asheville to meet the demand. So home prices in Asheville, until ultimately it becomes too unaffordable and people will find other really nice places that are more affordable, prices in Asheville will continue to go up more quickly than the national average.
All right. The second one, I'm actually surprised how many people are talking about MMT. So this has become part of the actual wider lexicon, right? And so will MMT save us from inflation, from large fiscal expenditures, not just what we've seen, but what we may be seeing soon with the infrastructure bill?
So MMT is what is the initials for modern monetary theory. It is a small group of economists who believe because the US dollar is the currency at which the world transacts things, that we can put as many dollars out there in terms of large federal budget deficits and just have the Fed finance it without the rest of the world worrying about it. We'll just, if we run budget deficits, we'll just print more dollars and fund it that way. And if inflation does go up, all we have to do then is raise taxes to slow the growth of the economy. So is that a reasonable thing or not? Well, one is we don't really know because it's never been tried before. On the other hand, much of what is going on now is MMT-like. Now, I would say that any of the Federal Reserve regional bank presidents and probably all of the board members would say, no, we are not doing MMT. We think MMT is lunacy. In practice, what they're doing is very much like MMT. They don't believe that inflation is going up beyond this temporary bump. And hopefully they're right. Does that mean MMT is correct? There are lots of reasons why something can happen. It doesn't mean the theory behind it is right. It just means it happened. I think the theory behind MMT is flawed. But we're not going to know for sure because sadly, actually not sadly, for the good of the country, they won't let the economists conduct experiments on the economy. So in that sense, we're not like physicists or chemists where we conduct controlled experiments. You should let us play with the economy and then we'll know it works. And then our forecast will be much better in the future. But it's probably best not to let us play with the economy. Now, the other part of that question was, will there be more fiscal policy coming? And indeed, there might be. President Biden, of course, is proposing a new infrastructure plan, infrastructure defined very broadly. But there's a lot of support for infrastructure spending in the country, and there's a lot of need for infrastructure spending in the economy. I think if properly defined, we could see strong bipartisan support in both houses of Congress for, again, properly defined, for an infrastructure bill. I think we will see an infrastructure bill passed. I don't know if it will be one that is smaller, that has bipartisan support, or is a bigger bill that is only Democratic support. That is unknown at this point. But I think we will see more fiscal policy. Now, as we know, as we've learned time after time, there are no shovel-ready projects, or virtually none. So infrastructure spending is not something that adds immediately to aggregate demand in the economy. And in fact, the whole point of it is, now it will eventually as the money is spent, the whole point of infrastructure spending, as with the Reagan tax cuts, it acts on the supply side of the economy. It should allow businesses to do more at lower costs. And hopefully it will. So it may, in fact, allow the economy to grow at a somewhat faster pace over the next decade or more, and allow the economy to be a little less inflation prone. So hopefully it acts more on the supply side of the economy than the demand side. Right now, the demand side of the economy does not need more stimulus. We're already going to grow very rapidly and surpass where we were.
So believe it or not, the next person actually asked about MMT, so you've already answered that, but they have a second part of the question that's really interesting. So they say, since the market went wild, I think we're talking about stock market here, during the downturn, how will it do when the economic activity normalizes? Will it go down since it went up during the COVID-19?
So nobody can actually forecast the stock market beyond, you get lucky sometimes, but you can look at things that tend to drive the stock market, and you can be right for longer term trends. The stock market clearly looks ahead. COVID took it by surprise. It took everybody by surprise. We had that huge drop in the stock market. But then the stock market moved up well before the economy did. Why? Because it could see that the Fed was easing monetary policy and fiscal policy was expansionary in an unprecedented way. And so the expectation was that growth would pick up. Now, did the stock market expect a record pickup in the economy? I don't know. I didn't ask the stock market, but it perhaps seemed to have responded that way. The economy can't continue to grow at the pace it's growing now. Does that mean the stock market will go down? The stock market goes down sometimes even in the best of economies. It never goes up in a straight line. It never goes down in a straight line. But if the economy continues to grow at an above trend pace, the trend in the stock market should be up, because that implies that corporate profits will rise. And as long as the stock market doesn't expect interest rates to go up so quickly, so that the present value of those future earnings are negative compared to where they are now, the trend in the stock market should be up. Now, if the stock market starts to think that inflation is getting out of hand and interest rates will go up rapidly, or it starts to expect a recession, maybe that, the Fed sees inflation is going up, and it's going to stomp on the brakes, that will cause a recession. While the economy is still growing, those things could cause the stock market to go down. But in the absence of those things, the trend in the stock market, with the economy growing and interest rates going up, but not too rapidly, should be higher.
Well, I'm going to actually ask a quick follow-up on that one. So, one piece of this story might be that the companies that are listed relative to ma and pa type firms, we're going to do better in the pandemic economy, the Amazons of the world, right? The tech companies, Zoom zoomed right on up there, right? And so there might be a little bit of a pullback as a result of that. Do you see that, or do you think this is just they've gained some ground that they will continue to take hold of even as the economy opens up further?
It clearly was a period of time which favored certain firms over others. The firms that relied on in-person activity, cruise lines, airlines, Disney, your local restaurant and bar, got crushed. They're already starting to come back, those that are in business, but we're going to see lots of businesses started. The entrepreneurial spirit that caused those small and mid-sized businesses to be started didn't go away. Those people will come back and form new businesses. If the economy were a zero-sum game, if those smaller and mid-sized businesses came back, where does it come from? Well, it has to come from the big businesses that did so well. But it's not a zero-sum game. The economy is going to continue to grow. Will the Amazons and the Zooms of the world grow as quickly with in-person activity coming back? Probably not. But will they shrink? Probably not. They just won't grow as quickly.
So one of the next questions is also about the infrastructure bill, but it's a good question in the sense of how much do you think this is going to change the forecast that you were providing, that if there was an infrastructure bill, how are the numbers going to change that you were presenting to us?
It depends on a couple of things. Number one, it depends on what's in the infrastructure bill. Is it a broad bill where lots of things in there are not infrastructure? Or is it a more narrow bill where it's really infrastructure, it's really supply side? And how is it paid for? So if it's a broader bill, there will be more spending up front because a lot of it is on things that don't have anything to do with shovel-ready projects. They're not infrastructure based. The narrower the bill, the less near-term impact, but the more positive it is over the longer run, because then you get the real supply side effects. So that's on the spending side. On the financing side, if it's financed by tax increases, the tax increases will slow spending in other parts of the economy. By enough to cause the economy to come to a stop? No. And we probably aren't going to get the 28% corporate rate, but we may well get a 25% corporate rate. I think that's probably pretty likely. Corporations will not be as profitable. They won't invest as much as they otherwise would, to the extent that some of that gets passed along in lower wages and a lower stock price perhaps, or at least lower dividends. That will slow spending as well, enough to offset at least the near-term impact of the infrastructure bill? No, but it will offset some of it. So think of it, if just have the infrastructure bill, the economy will grow at X. If you have the infrastructure bill and you pay for it with taxes, it'll be X minus Y, or Y is not as big as X. I don't know what those numbers are. It depends on what the taxes are. It depends on what the infrastructure spending actually looks like. Now, what happens if it gets funded out of debt? So we don't raise taxes at all. It's not clear. Most economists would have said before this period, well, government borrowing is going to crowd out private borrowing. Interest rates are going to go up because people are going to say, well, the government at some point has to raise taxes to pay for all this. But do they? Interest rates have gone up. Some of it is that real growth in the economy has picked up, that deficits have gone up, inflation has gone up. But golly, the 10 years at 1.55, that's still an historically really low number with record budget deficits. So if we simply make the budget deficit bigger, is that going to have an impact on interest rates? If it doesn't have an impact on interest rates, there's no crowding out. So the private sector doesn't get crowded out. We still get just as much corporate spending and business spending. The answer is we're much less certain about this now than we were before this started. Before this period, almost every economist would have said, well, this much government borrowing, even in a recession, but coming out, and with deficits that are huge as far as the eye can see, we will see interest rates going up a lot. But we haven't. So maybe we've looked at the economy incorrectly. Maybe there's something there. Maybe it's as simple as our interest rates are still so much higher than the rest of the world's that everybody wants US Treasury securities. And it could be that pickup in demand is offsetting the rise in supply. It's not all from the Fed buying things. If it is, it hasn't had much impact on inflation. But that might end. Maybe at some point the rest of the world starts to say, maybe the US isn't really the US. Maybe it's Argentina in disguise. And at some point, they can't pay for all this. Then interest rates will really go up. But it's not now. Maybe it's never, but there's a risk. So part of the question here is, do you want to take the risk? Right now, it looks like the odds of that are low, but are they always going to be low?
I really appreciate your answer to that. I teach an intermediate macroeconomics class, and I've been thinking to myself, because I'm about to teach the part on government debt, I'm like, we are so uncertain compared to where we have been as a profession. And that, for a class, that puts me in that uncomfortable position to say, we don't know. And to some degree, we don't. And that's what's wonderful from the intellectual side of this experiment. It's a big, interesting experiment that we have going on in a very cool, meaningful way, right?
It is, but your students are looking at Professor Tatum. What's the answer? You're going to ask this on an exam. What I won't know what to put down if you don't give me the answer.
Right.
They get uncomfortable when we don't know the answer.
Yeah, and we do too. So the next one, actually, you might not have a great answer for either. We've had great answers, but to this, we both don't know exactly what is the sustainable level of debt for the United States, though we're more open to the possibilities than probably we were 5-10 years ago. The next one, I give context to it, I think, is that, I particularly think about my students, and they have lived through some really dramatic things going on, sort of the once in 100-year events, if you will, right? The financial crisis, yes, exactly, right? So they've lived through some things. And so the next person raises the question, that there are some social and political potential unrest out there, geopolitical events. How's that going to change where the economy's going? And even just, I guess, the general question of living in a world that may be a little bit greater uncertainty than it was certainly when I was in college. How did the risk of uncertainty turn around and affect the outcomes?
It's a great question. One of the things that we see is, and one of the responses to that uncertainty, is that the saving rate for the economy is very high. So people who are working are making their salaries. People who weren't working are getting unemployment assistance. And then many people in both those categories are getting still more money from the government. So income is very high, and people aren't spending it as rapidly as they could, even with the 10%, nearly 10% increase in retail sales last month. The saving rate remains extraordinarily high. Part of that is what economists would call precautionary, because of uncertainty. We don't know what's going to happen. Maybe the virus will come back. Maybe something else will happen. Maybe I ought to not spend all this money I got. Maybe I ought to save some of it. I think over time, those very high saving rates will come down. Will they come down to where they were before COVID hit? Probably not. And that's the impact of having the COVID recession and the Great Recession within a decade of each other. One of the things that I'm in charge of nationwide is our economic scenario generator. And it's not this sort of usual economic model. It's a huge stochastic simulation model that does hundreds of thousands of simulations over the economy and interest rates. And we're interested in the left tail, the really bad events. Well, up until, fortunately before this event, but up until just a few years ago, the model never had the capability of having negative interest rates. We've never had negative interest rates in the US, for long-term rates, but we have in other parts of the world. So we changed it. The model now allows negative interest rates. That's a change in our thinking of where the economy could go. Now, do I think we're going to get a negative 10-year rate? No. But you know what? Where rates are now, if something happened tomorrow, I don't know what something is, but we went back into recession next week. Could we then see negative rates? Well, if the 10-year starting at 1.5, perhaps we could. So it is theoretically possible, and that's why it's in our economic scenario generator. But the probability is very low. Now, they've had negative rates in Europe and Japan, particularly in Japan, for quite a while. It doesn't seem to have helped their economies at all. And the Fed seems to be dead set against having negative interest rates, which is good because it doesn't seem to have boosted their economies very much, and it kills the financial sector. But that's the sort of thing that is just different now, just like this precautionary saving on the part of consumers. We think that will ebb, but how quickly is hard to know. If we get a number of years where we have pretty good growth, and no no real risk of a downturn. Even if growth just goes back to the 2% trend, then that precautionary saving will dwindle over time, but not for now. It's big right now.
Very good. This one comes from a student, and you've talked about housing prices, but there's the question about renting. So the question is this: while single-family home sales have risen at the expense of renters seeking suburbia, do you see renting in metropolitan areas normalizing within the next few years?
Well, I think home builders are building as many units, both rental and single-family, as they can. There were significant supply constraints. Land, workers, materials. The materials are mostly a supply chain problem, but land is not. It has to go through a zoning process. It just takes time. So just as with the single family side, on the multifamily side, most rental units are multifamily, although not all. We'll probably see a pickup in single family rental as well going forward. That's what my friends at home builders tell me. They keep waiting for that, and it may finally be happening. It's still going to take a while. So I think we're going to see rental increases be pretty high as well. Now, one of the things that is really pushing up housing activity right now is demographics. The millennials, the main part of the millennials are between 25 and 35. And that's when they form households, and that's when they rent and buy. So it's pushing up demand right now. The group behind them, the Gen Z, is a relatively smaller cohort. And that will take some of the pressure away from housing prices. But you're probably gonna have to wait 5 or 10 years for that.
And I think you basically answered the next question too, but I'll go ahead and ask it just to see if there's anything more you want to add. The person asked, will home ownership rates continue to fall long-term despite a continuation of low interest rates for the next few years?
Well, home ownership rates fell pretty significantly during the COVID recession. But they've come back. They're much stronger. Now, I have to say this, a lot of the demographic data from last year are not very precise. They're not good numbers. And the reason is that they're surveys. And normally the Census Bureau would send people out to talk, knock on doors. Well, they didn't do that during COVID. They relied on telephones. Well, as the political pollsters know, the telephone surveys aren't very accurate. So the numbers on household formations, vacant units, home ownership rates probably weren't very accurate, at least for the first 3 quarters of last year. The fourth quarter numbers were probably more accurate. They were actually sending people out again. So the home ownership rate never got up as high as the numbers last year indicated, but they were higher. So we did see an increase in home ownership rates. I don't think they'll go back to where they were at their peak, 2004, 2005, when we were almost at 70%. That's higher than can be sustained. But 65%, I think, is sustainable in this country, maybe even 66. If we'd fallen to about 63, I think we'll be at 65 or 66.
Okay, so we've still got some more questions. I just wanted to let the audience know many of you are hanging with us because they're good answers and good questions that are coming through. We're going to take another 14 minutes at most to go through this, but we'll have you all done at 8:30. And for those who've joined us, we really appreciate this and your commitment and interest in the crystal ball. And many of you have been doing this over the years, and so. Thank you for that, and we hope to see you again at future events. The next question, David, is coming from an alum, and I believe you've already addressed this question, and so I'm going to go ahead and pass on that one unless there's something you want to go with. But the one that follows also from an alum, and so it's good to see folks who've majored in economics and gone on to do things and come back to watch this, and that's
hopefully
actually
they're going to do useful things, not just become economists.
Hey now. And so So what's nice about this event, right? I mean, we can actually do this from our homes, and there are people who are coming from all over the country to watch this, different than perhaps in previous years. So there are some good things about doing it this way as well. But the one I'm about to ask you from is actually from someone here in the region, and they were basically asking, what are your thoughts on the long-term impact of COVID changes to the marketplace? In other words, commercial office space, migration in or out of high-density markets?
Yeah. Another really excellent question. We're at peak working remotely right now. It will go down from here. How much? Don't know. Some. Will it go back to where it was before? No, because for many businesses, it will be less expensive for them to operate, and they can operate just as well with a more remote workforce. But lots of firms want people to come back. If you listen to Jamie Dimon, for example, he's adamant he wants people to come back. He doesn't think it's fair to junior people who work at JPM. They're missing lots of things by not being in the office. It's harder for them to advance. Our CEO wants people to come back to the office, although we're going to have a fair amount of flexibility about whether people working with their managers will come back full-time or only part-time in the office. So I don't think we'll go back to where we were, but we won't be as remote as we are now. So that means that the demand for office space, the demand for housing in cities, both will be higher than it is now, but at least for a while, won't go back to where it was before COVID hit. Now, over time, again, it's not a zero-sum game where the economy grows. So even if only half the people go back to the office, add that year over year over year, we'll eventually get back to the number of people being greater than were in the office 100% before we went to COVID. Now, it may take a long time, but eventually we'll get back to that. But for at least some period of time, I think the demand for things in cities, businesses, housing, will be less than it was because not everybody's going to need to go back into the city to work, or wherever your workplace is. But for most people, many people, it's in a city. It's at least in a metro area.
All right. One of our questions came in through the chat a little bit earlier, and so I'm going to turn to it to see your reaction to this. It said, some economists claim that 6% inflation rate for several years would help the economy by helping to resolve the U.S. debt problem, lifting wages, and stimulating economic growth. What do you think about this?
Let's see. If you were I mentioned Joe and I like baseball. If you were a baseball player, you might make the Hall of Fame, but only because you hit 333. So you mentioned three things there. Higher inflation does help the debt problem because you're paying back in dollars that are worth less. It will lift wages, but it'll lift prices at least as quickly. So real wages won't go up, or at least no faster than if inflation were at 2%. In fact, the evidence is that as inflation moves higher, wages tend to lag behind. So workers would probably do worse as inflation moved to 6%. And the argument is sometimes made that prices will help grease the wheel of the economy. I've never believed that. I think there were a number. Now, I grew up as a product of the Great Inflation. Went to college and graduate school as inflation was moving well up into double digits. There were a number, I think, of very good papers back then, which suggested that the economy grows most quickly when inflation is low and stable, that it allows the price system to do its job of indicating where money should flow in terms of businesses and industries. When inflation is higher, you can't tell. When inflation is variable, it's even harder to tell. Now, I would claim that we've had a fairly low, stable inflation environment for the last 20 years. The Fed should have simply declared victory and gone home. They did a great job. They did what they said they needed to do. Now, the Fed wants to have a 2% long-term inflation rate. We've been below that. there are various technical reasons why the Fed wants inflation as high as 2% and why they're willing to get that on average. They're willing to go a little bit above that for a while. How much above that and how long a while is, they're not saying, mostly because they don't know either. I think that's a mistake. People, if you listen to Jay Powell and other members of the Fed, they say, look, if inflation goes higher than we want, we have the mechanisms to bring it back. They do, and that's called causing a recession. I think every time, almost every time, and probably every time, that the Fed has tried to rein in inflation, a recession has followed. So they're right in that regard. But is that what we want? I'd rather have the Fed be a little more proactive with potential inflation so that tightening, when it does come, and eventually comes, is less rather than more. And so recessions maybe get pushed out longer rather than occur more quickly. So I don't think much of that idea.
Good answer. The next one, I think about, when we were facing the Great Recession, there was the Ben Bernanke was Fed chair. And, from my standpoint, his experience as an academic who had studied the Great Depression and what was done so poorly in the Great Depression really informed the way he was thinking, and he thought outside the box, and others around him did as well. And so there's still, there's some sense that this was going slower than it should, and you even referenced that. And so this question is in that context. It says, when you stated that the Fed reacted faster than ever before by only taking a week to drop the federal funds rate due to COVID, was this because of the lack of urgency in the Great Recession? And if something like this happens again, would they act even faster than a week?
So part of the problem is that economic data tends to be lagged and it tends to be variable. So the recession might have started in December of 2007, but we didn't see that data really until February. And the Fed isn't going to act until it really sees things are going on. Plus, the recession itself looked to be a fairly modest recession for the first 6 months. It wasn't until we got to the fall when Lehman Brothers went under that financial markets seized up. And the Fed and the Treasury Department could see we are staring in a depression in the face. And indeed, if Ben Bernanke and Hank Paulson had not done the things they had done in September and October of 2008, we might well have gone into a depression then. Things were moving too quickly that you had to suddenly get ahead of it. And they hadn't gotten ahead of it. But again, the downturn didn't look to be depression-like. The Fed had the ability to see what happens in the worst circumstance just a decade ago. And they said, well, we saw what happened then. We're not going to let that happen on our watch. But not only that, you didn't have to wait a long time to see what happened with the data. You could see with the weekly unemployment claims, when state and local governments told businesses, send everybody home, they sent everybody home. And we saw a rise in weekly unemployment claims that was unprecedented. I'm going to look over here for a minute. My home office here, it's like a trading room. I've got 3 computers on my desk. So I'm going to look while I'm talking to you at another one of my computers that has my economic database here. So I'm going to look at the weekly unemployment insurance claims. And if we look at, all right, nope, I've gone back too far, sorry. So we're going back to the beginning of 2020. Here we are. So in the second week of February in 2020, there were 256,000 unemployment claims. That is historically very low. It was up from 212 the week before. The following week, the third week of March, it was 2.9 million. That was a record. Usually these things go up, but they go up more smoothly. As we went It went up tenfold. We've never seen that before. So the Fed was able to look at weekly numbers and say, oh my goodness, look what just happened to the economy. They didn't have to wait to see other numbers. They could tell from this that the economy was simply cratering.
So I'm at that point that I'm like, oh, I want you to answer the next three questions, the final three, but we're toward the very end. So let me just say, there's a good question about crypto securities. There's a good question about why do you see the things over trend, about the international issues.
Cryptos aren't a currency yet, but people are using them as a way as a precautionary thing for things that might happen.
Yeah.
But
oh yeah.
You know what? My guess is within 10 years, most of the world central banks will have their own cryptocurrencies.
Oh, we will. I'll write this forecast down. So there's two. Maybe we could do two quick ones, and then I'll give it just an announcement on where people could find this if they want to. So the other one is, why do you think that we're going to be over potential? And then the following is, do you see some international issues out there that we need to be concerned about?
So I think we'll be above potential simply because the growth rate of the economy is going to be so rapid this year. Again, the fastest since 84, maybe the fastest since 51. When we update our forecast, we'll probably move it from 6.1 to 6.5 for the year. That takes us well above where we were at the peak before. And the trend before was only like 2% growth a year. So it's simply arithmetic. If you're going to grow that fast this year and the beginning of next year, and you compare it to the trend rate of growth, we hadn't had the downturn, you get above potential. And we get there at the ends. Well, we get there during strong expansions. We get there, and we're going to this time as well. It's just much sooner after the recession than we normally see.
Any international issues on the horizon as our very last question here?
There are bad demographic issues internationally in Europe, Russia, and China, and Japan. Our demographics aren't good, but so much better than any of theirs. There are geopolitical things that worry me a lot, and they ought to worry everybody. Hopefully they don't occur. But just as there's a distribution of economic results that could occur, there's a distribution of geopolitical events that could occur that may be low probability, but they're not zero probability. And those things could be very problematic.
All right. So I hope to have this posted up on our department website. There's actually a few of them from the last fall, if some of you all were with us, but they're there. Dr. Heather Boucher, who's now at the Council of Economic Advisors, Dietrich Vollrath, who is a growth economist, and Sandy Darity and Kirsten Mullins, who do great research on reparations. All that's on the department website. Come visit us there if you want. I'm just so appreciative of Jim, who couldn't be with us tonight, but has been a part of this for all but the first 2 years, to Joe, who on so many levels have done so much, including founding this and keeping it going for 35 years. I run into people on the street all the time who are like, oh, the crystal ball, I love going to that event. And actually, it's sad. He used a mailing list, and I didn't this year, so I don't even have a way to inform everybody that this was going on. And so we still had strong numbers with this as well. But David, you have been a strong part of this through the years, your banter and your insights and everything that you have done. We really, truly appreciate your intellect and part of all this as well.
It's my pleasure to be part of this and to help with the memory of Joe. And I hope we find a way to keep it going.
I do too. And so if you all are alums, get in touch with us. We'd love to hear from you. If you're community members and you're appreciative of this, we'd like to hear about that as well. And we look for you all at future events. Take care, you all.
Thanks, everyone.